So I'll start with a little bit of a story about myself. I was a venture capitalist, um, was a partner in Intel Capital, and as an investment manager, also did a lot of business development and for Intel. As part of that, I've done a lot of work also from the engineering side. I have many patents, algorithms that I've designed. I have a lot of technical background. I'm also the founder of the Intel Startup Program. But I'm also entrepreneur in heart, and also I raised my kids to be entrepreneurs, so they started at early age to create things. Right now, I'm a partner in Zero Gravity Capital, which is a fund that is backed by the European Bank. We're mainly focusing and investing in early stage companies. And as part of that, what I'm going to go over is main highlights of how venture capital looks in basically what I call crisis mode, what to do, what not to do, and kind of highlight of things that needs to be uh, addressed when you're addressing venture capital, but also what I predict will be the performance of the venture capital vintage. So let's first of all talk about the psychology effects when we look at what happens to people in uncertainty. First of all, they like to go on the safe side. What does it mean? It means that a lot of people, and I'm referring to I think Joseph, you mentioned that in the last presentation, you talked about the fact that people are reserving cash and not basically sitting on their cash or sitting on money, and it also reflects to a lot of venture capitalists, and they want to take the safe bets. They look a little more thoroughly onto the companies, and also a lot of funds that are in the midst of raising the second fund or third fund. Normally, this is where things get a little bit of hiccups. So a lot of venture capitalists in this time basically invest out of the nostril of the fund and not necessarily raise or close new funds. Again, I'm saying it because when people start to smell that the crisis is starting to lift off, then or to roll back, there is a lot of there is a lot of money that gets into venture capital. And as we said, people take less risks. What does it mean people take less risks? So people would not go into areas where they are not certain of. And the other thing that is very predominant is people hoard resources. What does it mean that people hoard resources? Is people are basically, if they have cash, they sit on the cash. If they have merchandise, they sit on the merchandise, and they're less proactive in trying to liquidate assets. I mean, it depends on their cash flow, but a lot of people do not like to liquidate assets in loss. But on the other hand, there is a lot of opportunities from companies that go bankrupt, and so there is a lot of market demand and opportunity that is created by basically competitors that are vanishing. And what we need to know also is that everybody gets a wild card, and I think that a wild card is something that is important to understand. When you get dealt with a wild card, one of the things that happens is how do people react to that wild card, and how do people act in these cases? So a few things that happened into venture capital. It's first of all harder to raise capital because a lot of the venture capitals are kind of moving a little bit slower, and also it's very hard for them to do diligence because it's very hard to predict where the market would go. It's very hard to predict how the customers will react. There is a lot of wild cards going around. So this is one of the reasons that venture capital works slightly different than the normal investors. And so when we look at the startup monetary and how does that work, basically what we can see is we can see that there is a lot of So there is basically the value of death of companies, which is the lower point that you can see over here. And this is, so if you get to this point when you're trying to raise money, sometimes it's a problem because it will be difficult for you to raise money or to do another round. Here, normally what I recommend to our portfolios is to go and look into a few other options, not just doing rounds, but sometimes doing bridge, convertible loan, or safe is something that is slightly better, because then you can enjoy the better, as a founder, you can enjoy the better valuation later on. And also, it's very hard to state the valuation of a company when we look at the companies in the crisis or crisis mode. So when we look at the venture capitalist, a lot of in the vintage, one of the things that I'll show you later is in insights. Venture capital is actually performing better in the crisis vintage. So 2008 was a great year for a venture capital, and that vintage generated 2 or 3x returns, and it's something that repeated also at the 2001 post the 2000 crisis. And this is something that my assumption that will repeat as well in the upcoming years. So we talked about what is different from a normal investor to a venture capitalist. One of the things that you can see is they're more risk taking. So less of the numbers, and when other investors are waiting to see how market reacts or how trends are happening in terms of monetary, venture capitalists basically we use our analysis tools in order to understand what is the risk and where do we want to invest, meaning that venture capitalists are a little bit more adaptive in investments. So there was a lot of money that is poured into, for example, telemedicine and VOD or video or media distribution applications at the moment, or social video conferencing. You can even see it with shares of tech companies like Zoom or such. And venture capital does not stop on crisis. One of the things is that when you manage a fund, your management fee continue. So you may take it a bit slow, and you will put less money in order to make sure that you have enough reserve to maintain your portfolio in the coming years. And so as I was talking, you can see the vintage. So first of all, the activity, you see that there is almost no decrease in 2008. You can see that there is, in crisis mode, there is, or when crisis happened, financial crisis, you see that there is the number of deals does not decrease, but the value of the deals does decrease. And again, it goes back to the intuition that a lot of fund managers have when they're managing their assets. They want to keep a little bit more reserve for their portfolio. So that's one of the reasons that they keep a little bit more of monetary reserve. And when you can look at the number of deals, you can see the number of deals. There is a decrease, but the decrease is not that substantial. Another important point is that when we look at early stage VCs, we can see that the number of deals and money is pretty much flat across, and this is something that is, I think, very reassuring to early stage companies, And you can see that the angel in early stage starts to wake up after the crisis, but it doesn't, almost is not affected by the crisis. I think that a lot of VCs use the opportunity of the crisis in order to dump bad performing portfolio companies and basically to write them off. And as I promised you, you can see here the after 2008, you can see that 2008 was the crisis, and then you can see post the crisis, meaning that the vintage of 2008 and the predecessors, you can see a huge increase in the returns, way over S&P 500. And I think that this is extremely interesting. One of the reasons that this phenomenon happens is that you have the way that a lot of venture capitalists are doing their valuation is by revenue multiplier and looking at the multipliers of reference in public companies. And because the public companies are the multipliers decreases during the crisis, then the valuation decreases. So there is a better starting point for the venture capital when they go into investments. And I think that this is something that is important to understand, because a lot of founders are not looking into raising money now or waiting. And I think that it's also a good opportunity to kind of test the water. There is not a lot of changes in the tables that venture capital uses. So I think that the changes of valuation is basically right now is not as harsh as it would be in about 6 months. The second thing is let's think about what makes so when we look at venture capital, so how do I decide which entrepreneurs I want to invest in? And one of the things when we look at crisis, or how do I talk to my portfolio companies, is one of the things that I'm telling them is the importance of tenacity. So there is a lot of unknowns, uncertainty, and you need to basically keep your strength, keep the movement and the momentum, and basically use the down market momentum in order to climb back up. And I think that it's extremely important, especially to the founders. We'll talk about it a little bit more in my next slide, and also about elasticity, which is highly important. And elastic is because you want to bounce back, and you want to be able to shift and be agile enough, and it's I think it's crucial, and it's something that a lot of people say, especially in crisis mode. There's a lot of opportunities and things that are happening and occurring, and I think that it's really crucial that people would kind of examine and look at what they're doing and make sure that they're doing the right thing. Also, when we look at the actions, you need to act fast. What does it mean, act fast? Sometimes we take time with the lawyers or legal department until we sign with. This is the time where basically you need to hit the iron when it's boiling, and not postpone anything. And also the market. A lot of startups start their assumption or business assumptions after analyzing the market, and then basically they move forward. I think that when there is a crisis, it's important to re-examine and look into the market. So let me go into these topics and maybe drill down into these topics. One of the important things, if we look into if we look into a startup, is the tenacity. This is the Ramon crater in Israel, and basically this is how a startup should be. So it's a small stream of water that needs to basically carve through a huge mountain and create a crater, and to create an effect on the landscape. And I think that when we look at crisis like the coronavirus or COVID-19, there there is unique opportunities, but we need to make sure that we are not spread and we are running narrow, and we can basically create the effect on the landscape that we want. And it's sometimes easier to do it when we are encountering we are encountering difficulties, because I think that in that time the tenacity is crucial when we are trying to carve through the market. Where does those opportunities come and arise from venture? When we look at venture capital, it's first of all, we need to look for these resilient, a little bit more psychological resilient, and people that have tenacity, that would not bend down in 6 months when the market would not bounce back. And it's really important to emphasize that when you're a venture capital. When you're a founder, you need to also understand and talk to your team about it. The second thing is elasticity, and this is the picture of the Yukon River that basically it swirls around. It's almost double the size, because of all the twirls that it has on the way. And it's pretty similar to how you need to act in a crisis mode. Is basically to shift fast and move fast, and not go and slam into the walls, and make sure that you have enough energy or enough power in order to cross the next barrier. And this is very important when you look at the financial, basically how you plan your financials. I'll go back to the slide that I was showing you. Basically, it's well known in the venture capital, but the value of death of companies is, before you get to a break even, is a very sensitive point, because you would need to raise more money. And sometimes in situation where there's a downturn in the market, or there is a world economical crisis, or in this case it's a medical crisis, there is basically the value of death become the value of doom, and it's very hard to bounce back, because sometimes for some businesses it's very hard to bounce back. I know at least 4 startups that were doing tourism that just decided to close down, and they will reopen again in a year maybe. And again, we don't know if they will ever reopen, but it's basically, it's one of the things that happens when you don't have enough cash. So as a founder, you need to make sure that you have enough cash reserves. As a fund, I make sure that all my portfolio companies that have enough cash in order to sustain them to the next round, because a lot of the companies are good, but sometimes it's just a little bit of oxygen that they need in order to bounce back and get into break even. So that was about elasticity in action. The ability for us to move, to get a yes, no, is crucial, especially in this state. A lot of VCs they get drained out of resources, and sometimes they just, until they get the next tranches or the next investments, or some money into the nostro, they hold the founders. And I think that it's important to have it's important to make sure that these that you get the yes no as fast as possible, not that let people drag you down, because mostly people, as I mentioned at the beginning, they try to avoid making decisions, and they're trying to be very risk averse when we look to action. So sometimes we need to pull people into action, and it's even more in this situation. I think it's more prominent and more important to pay attention and to drive your partners or your customers or your potential customers or your investors into a yes/no decision, because you don't want to waste energy on things that are futile. Market. It's very important when we go and start a startup. It's very important to have a clear understanding of the market, but the market changes. So if I look at the airline industry today, it's a completely different landscape than it was 6 months ago, or even 4 months ago, even 2 months ago. And it's really important to re-examine the market and where you headed, because there is a lot of changes and they're happening fast. And so one of the things I do is I talk to a lot of people from the industries that I'm targeting, and I'm kind of trying to feel the breeze. I'm trying to ask them what's selling, what's not selling, what's happening, what do you feel, and what's going on. And I think it's crucial for startups, especially now because there are no conferences. So how do you get a sniff onto the market, and not necessarily the McKinsey or other reports, because everybody reads them, so it doesn't give you any advantage. So you need to scout and be a little bit more diligent in trying to find the information and expanding their network. And it's a good time to kind of give a courtesy call to people from your past and try to reach out. So again, what do you need to do as a founder or as a venture capital? First of all, is be flexible, and it's a good time to, if you're a venture capital, to see if your companies need to pivot or change. It's for a founder. Go ahead and see if you need to pivot. I always recommend to all the companies, make sure that you have 18 months of runway, because it's harder to do growth rounds now. Because in growth rounds you need to have metrics that are equivalent, and you need to start showing results. So a lot of the companies that are now in the valley of death, or in the doomsday, where they're not break even, you need to make sure that you have at least 18 months of runway, and you need to be very focused at what will investors use as KPIs in order to analyze your company. The third thing is keep the investor updated, especially when there is things that are there's uncertainty. There's a lot of things that are changing in the company. Make sure that you update your investors, because you don't want to surprise them, and also you may hear a good advice, or they can point you into the right direction. And it's always a good time to network and branch out and to get the market and other insights. I think it's really crucial and really important to use this time to branch out. So I covered all the topics, and basically now we're open to discussion. There's not a lot of people right now in the session, or active in the session, but if you have any questions, that's the perfect time for you to do it. None? Okay, so maybe just for the sake of the recording, we'll go back into basically some insights into venture capital, and because one of the important things to understand when you look into the venture capital market is that we have the venture capital market is basically relying on the valuations of companies that have been into further stages. So as long as companies are up the stream here, this is how you correlate the valuation down the stream. And so it's really important to keep analyzing how the deal structure changes, and relying on data that happened in even 2019 may not be even relevant to how the deal structure would be. So one of the important things that when we look into how do we analyze the venture capital market is, as a founder, you need to make sure that that you understand how valuation is done, and basically understanding the reference in valuation. And as a venture capital, it's important to look at the variance and changes that are happening in the future, because that's how you basically, most of the valuation techniques are done, is by relying on same companies that had the results in the past. And when we look into And when we look into the basically the seed or seed, as I mentioned before, the seed is almost not affected in crisis, but the total amount of money is. So I think that in this time, it's better to do smaller rounds, focus again in bridge rounds and into safe in safe or convertible loans, which gives you a percentage of the net valuation that will be set in the future in the round, and make sure that you have at least 18 months of cash. So basically, that's kind of what I've focused with most of my portfolios. Um, uh, so I think that that's it. Any questions or anything that you want, any point that you want me to clarify? Let me look at the chat for a second. So I'll stop sharing and look at the chat. Okay, so I was asked here when just a second. So how do you understand where the market is trending? So one, it's very hard when we look at situations like COVID or the 2000 share collapse or any other time there is economical downturn. There is something that basically there is a lot of unknowns. But we do know where there is always demands and where always things will, we can assume that they will bounce back at least to uh, some level that have been before. So what we try to do is we try to, first of all, talk to a lot of people that are in that business. So for example, one of my investments is they're doing ads. So I did talk to a few ad providers, some people in Google, understand like what they're feeling, what's the trend, and trying to understand if that helps them. Another thing that I do when I analyze the market is